Hello there. So this is for the subject monetary policy and central banking. Specific topic for this video, BSP Consolidated Supervision. So we have here an article taken from the BSP website, bsp.gov.ph. So essentially, I think this is some sort of study conducted by Maria Dolores Yuvienko, Consolidated Supervision in the Philippines. Okay. So as a regulatory authority, the BSP is the sole regulatory authority overseeing all the banks and financial institutions in the country. Okay. Although, of course, there are related regulatory agencies like the SEC, supervising all partnerships and corporations in the Philippines. And then we also have the PSP, Philippine Stock Exchange, overseeing all publicly traded companies. Okay. Although not all banks or financial institutions are under PSE, normally we have the universal banks and the commercial banks that are publicly traded. Okay. And then, of course, they are also complying with the tax regulations and other business-related regulations that we have here in the Philippines. Okay, so I read this article already, and it's essentially 7 pages, right? And there are a few contents, but I've made some summaries here, which I'm going to discuss with you. Okay. So the consolidated supervision approach has been adopted by the BSP in 1998. So essentially, we have the Basel Core Principles, BCP. I think these have been recommended by the IMF and the World Bank, and normally all central banks or majority of central banks around the world have adopted the Basel Core Principles. So essentially, these are internationally accepted guidelines on assessing financial institutions, supervision done by central banks, activities or supervision that would encourage or support international transactions, ease of payment. And then we have the uniformity in guidelines, because that is needed to, again, support economic transactions between countries, right? And then currently, also supporting modernization of financial activity. So majority we're going online, digital payments, or we have them already, but it still needs more, supervision and study in that regard to ensure that it would not be used for fraud or any criminal activities. And of course, to prevent the commission of those things, because there are still people who have been, scammed. Their private information have been taken from them one way or another by scammers, criminals, and so they're trying to tighten the security on digital payments, right? Of course, OTP has been introduced. Before finalizing a transaction, you would need to enter the code, being sent to your phone, which is why you shouldn't be sharing it to others. Okay. So again, we have the Basel Core Principles. Those are the guidelines that the central banks are following, okay, with regards to their supervision of their respective financial systems. So again, the financial system, you have the regulatory body, and then you have the financial institutions, banks and non-banks, and then you have the general public that are transacting with the banks and essentially putting their money, their funds into the hands or into the management of the banks. That's why it needs regulation to protect the interests of the public as well. Okay. And so essentially they just wanted to ensure that the banks are operating well and that they are able to properly handle the funds of the people. Okay. And of course, they also support the economic growth and development of the country. Okay. And then aside from that, things that have been discussed in this article, we have the corporate groupings. Essentially, there are 3. We have the banking group, mixed activity group, and the financial conglomerate. So the banking group, you have your main head office or head office. And then certain banks, especially universal and commercial banks, they have a lot of branches. Okay, so that's a banking group. And then we have our mixed activity group. It's a group, but then they are involved in different activities that are, financial in nature, but somewhat related to each other still, okay? And then you have your financial conglomerate. So it's a group, but the composition is involved in different things, not normally carried out by one company or, one business, because it's not allowed. So you have your banking, trading and securities, and insurance. Normally, this cannot be done by just one company or one institution. So what they do is they form a financial conglomerate so that they have a group of companies or related groups or related companies that would help each other out in offering these financial services to their respective clients. Okay, so if you've heard of let's say BPI, BPI is a bank, is an insurance company, so they've cooperated. I think it was a joint venture wherein BPI can offer what do you call this, insurance services while at the location or premises of the bank. Okay, I think other banks have also partnered with other companies to create this financial conglomerate. Okay, and then other than that, moving on. So we have the single agency. Okay, so we have the supervision. Okay, we have the central bank doing the supervision. It's the only authority that has the authority to supervise, to implement the rules and regulations, right? So under the BSP, they have, themes to conduct the audit or to review the banks and other financial institutions under their jurisdiction or under their authority. Okay? And then for the consolidated supervision, yun nga, isa lang ang supervise ng mga bangko. Only one agency is responsible for it. Okay? So that would mean uniformity, same guidelines or protocol in the review process, same criteria, same benchmark and requirements while conducting the investigation. And then also information is shared. Information that has been gathered by one team could be shared with the others who would also be working in the particular group or particular type of bank. Okay, and shared by everyone involved in it. Okay, so imagine if there's two or more agencies that are conducting the investigation. So it's more decentralized, but there could be issues with regards to uniformity of the process being followed, who's ultimately responsible, what if one messes up, and then it would also be susceptible to fraud and corruption. So that's why there's only one authority. Okay, if they mess up, then it's them that's going to be held responsible. Okay, and then for the requirements that they have that they impose on financial institutions, of course we have the capital adequacy. Before you can start operating as a bank, there are minimum capital requirements, so capital adequacy, and that's related to credit and market risk. Okay, this would allow them to properly engage in operations. And then it's also in accordance with the Basel Capital Accord. So there are minimum recommendations. And then for the reserve requirement, I think the minimum is 8%. So central banks can, of course, impose higher limits, but the minimum is 8, as adjusted by the Basel Capital Accord. And then they also need to ensure to reduce the exposure. Okay, so they are imposing exposure limits. What do we mean by exposure limits? So let's say a bank or a financial institution is making investments. They cannot invest in a single entity they cannot invest all of their money into a certain investment by one entity. Okay, they have to diversify their investments, short-term and long-term, and then not just one company, but many companies. And then these companies should not be in just one industry. It should be in many industries. So they put limits on those things. How much can you put in short-term investments? How much can you put, not necessarily how much, but more on limits. What's the maximum amount that you can put on short-term investments, long-term investments, how much can you put on one particular industry, and then how much is the maximum that you can put in one particular company. And then there are also limits on how much can you lend to one particular borrower. Okay, so they are limiting the exposure to these things. And then we also have the DOS3, directors, officers, stakeholders, and related individuals. So normally, if you are applying for a position in a bank, they have the application form and they would ask, are you related to any DOS3 of the bank? Okay, up to the fourth consanguinity, if I'm not mistaken. Okay. So because they're trying to minimize the relationships between the management of the bank. Okay. I think they're doing it to prevent the possibility of collusion, and collusion is needed to commit a fraud. So in a way, it's a good internal control so that they could prevent those kind of activities. Okay. And I think there's a part here, qualitative consolidated supervision. Okay. Consolidated in such that supervision is all done by the BSP. Okay, the BSP has a monetary board, and then under the monetary board, they probably have different teams, departments or teams that would specialize in certain bank criteria or bank types, and then of course particular banks. Okay. So under the qualitative consolidated supervision, what I've read here are the following. This is to ensure appropriateness. Qualitative CS is done to ensure appropriateness and completeness of the coverage in the scope of the risk management system. So it's to ensure that the banks do have risk management in place. Okay. And then sufficiency and effectivity of internal controls and the conduct of internal audit. Independence of operations. They are not reliant on other branches or on their head office. This is particularly true for, branches of a particular banking group. And then limit exposure. They want to limit exposure. Coordination. Effectivity of coordination, and then sharing of information. As for the limitations, I think it was around this part. The limitations on single borrowers limit, ceilings on DOS3 loans. DOS3 can still borrow money from the bank, but there are limits, right? And then investment to a single enterprise, there are limits. Industry limits, that's also there. And then compliance with risk-based capital ratio. So with regards to the financials, there are certain ratios that they would need to comply with. Okay. Solvency, liquidity, operational efficiency, okay, capital adequacy, of course. And then you have your risk mitigation, existence and implementation of the risk management to eliminate or to mitigate the risk consequences that they are exposed to. And then overall, the success of the consolidated supervision would require actually close coordination between regulatory agencies and the legislators. Okay. Normally, the BSP could issue circulars for the rules and regulations, but there are certain things that they cannot issue, which would need proper passage of laws. So in that sense, they would need the legislators. And then cooperation of banks and its related companies. They should, allow the BSP to conduct these examinations, work with them. And then if the BSP examiner notice, any thing that would be a cause for concern, then the bank should be willing to work out those things and ensure that those would not pose as problems in the future or would not cause any problems for, of course, the business, the BSP, and the financial system as a whole. Okay. So essentially, that's the content of this particular document. Okay. I think one of the things that they've mentioned frequently here is the exposure limits. I think it also centered on the risk management, okay? And of course, coordination between these parties to ensure the success of the supervision. Again, the supervision is normally to ensure compliance with laws and regulations. Okay, so that's it for this one. Thanks and bye.